Interest rates are starting to rise for you savers, not borrowers, for you savers. This is a good thing. What does it mean? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Quick disclaimer to those of you that are daily watchers, you'll notice I'm now tan. That is right. We are at the ballpark for baseball and softball and all that sort of stuff every single night. So I'm just going to tell you, for the next 6 months, you're going to see a tan Mike, the CFP, and after that, that'll fade. And for a few months in the winter, I'll be pale again, and then it'll be back. But yeah, it almost looks like a different person. So interest rates, though. Interest rates are changing, and it could be good news. Now, the bad news is we know interest rates have changed. If you're borrowing, then that's a negative, okay? Look at mortgage rates, okay? And that's not even the purpose of today's video, but if you're, again, a daily watcher, wow, 5.3%. I remember just a couple months ago when I did a video about, hey, mortgage rates are surging. Do you think we'll see 5% this year? My goodness, 5.3%. Wow. Now, if we know interest rates as a borrower are going up, and therefore, given the choice between a borrower, a lender, or an owner, I want to be an owner, okay? I want to be an owner. Sometimes I want to lend, because that's a little bit less risk. I can still get a return. But I want to be a borrower the least amount of times, right? Because that's where I'm paying interest. Now, you could leverage, and we'll talk about that actually tomorrow's video about the negatives of housing values going up so much. But I digress here. Interest rates for savers have actually started to respond. Let's get into this. Now, I told you as the Federal Reserve would start raising interest rates, even if they had to do so aggressively, savers, you're not going to immediately feel an increase in your savings account in the interest that you're earning like you would when you're paying interest for a loan that's variable, okay? Those variable interest rates where you owe money, those will skyrocket immediately. The savings account interest that you get, it's going to take a little bit of time. Take a look here at this chart. It's been 15 years since you've been able to earn enough money on a savings account to even get close to competing with inflation. We're never going back, guys. I hope I'm wrong. I don't think we're ever going back where interest rates actually equal inflation rates. I just don't see it, okay? And so especially with inflation being so high, interest rates hopefully on savings accounts will start running up. I'm going to show you that data in a second, but I don't think we're going to get close to, hopefully inflation's got to come down to 3-4% over the next couple of years, and we might see interest rates get back up to 2%, something like that. I don't see them keeping up with inflation. I hope I'm wrong. But here's the good news, okay? My favorite place to have my emergency fund dollars is a high yield savings account, okay? So why is that? Because your emergency fund is your financial confidence account, okay? Meaning when a curveball flies at you, when you've got something that comes out of left field, when you have an emergency, a sudden bill, a health expense that you weren't expecting, a loss of income, something like that, then you've got resources at your disposal, okay? And because you've got that at all times, even though emergencies come very infrequently, that allows you to go gangbusters, go very aggressive at the goals that you're trying to pursue. You've got the confidence because you've got the safety net in place, okay? You catch up to me? So that emergency fund, that financial bank account, or financial confidence account should have 3 qualities to it. Number 1, it needs to be FDIC insured, because it's very possible you could have an emergency at the same time the economy's having an emergency. And you don't want to play that tug of war, okay? You need to know that those dollars are reliable and they're guaranteed, okay? So FDIC insured, so therefore they shouldn't be invested, okay? They should be FDIC insured. That's number 1. Number 2, they need to be liquid. So that means you shouldn't be putting them in some sort of fixed account where you can't touch it for a certain period of time. And I'd even argue, as attractive as I bonds are right now, I'd be careful about putting too much or putting your emergency fund in I bond, okay? Just because it needs to be liquid. You never know when an emergency is going to come up, okay? And then third, I would tell you it needs to be free. Banks are set up so that you shouldn't have to pay to have an account they're already getting their fee out of the interest. I mean, basically they're lending money out 4, 5, 6%, and they're only giving you like a tiny less than 1%. So they're already keeping the fee. There shouldn't be an additional fee on top of it. So FDIC insured, liquid, and free. After that, get the highest interest rate possible. Where can you do that? High yield savings accounts. Take a look at these interest rates. Guys, just recently, these were 0.4%, 0.5%. Now many of them up to 0.6%. That did happen pretty quick. It took about a month from the first interest rate increase to now these interest rates going up. Yes, the Federal Reserve has increased interest rates to 75 basis points. And we're seeing a 10 basis point increase in the interest that you're earning. Again, you can complain about it, but make sure that you've got your emergency fund in a high yield money market account that has those qualities, and hopefully you're able to get a more competitive interest rate. Not anywhere close to inflation, but a better interest rate than what it had before. I mean, speaking of, savings accounts are still 0.01%. So a high yield or high interest money market is certainly going to be more competitive, even though not keeping up with inflation, more competitive than the savings account. You want to go a little bit longer term, so dollars that aren't for emergencies. These would be investment dollars, but maybe you're low risk, or maybe you want to have some low risk dollars that make sense in your situation. Fixed accounts have increased their interest rates as well, almost 1%. Now, can't quote those here because lots of different products and tools. I'm not endorsing any of them. You got to talk to your CFP, see what makes sense in your situation. But a 3-year kind of fixed, sort of structured investment like that, if it was a guaranteed, multi-year guaranteed account, then you're going to have maybe a 2.15, 2.25 interest rate for 3 years. Now we're seeing that up above 3%. So that's fantastic. Now with those dollars, again, those are investments. You are going to lock them up for a certain period of time where they're essentially not touchable. If interest rates go up a lot during that time, there's some opportunity cost there. If inflation stays really high, again, you're not going to be keeping up with inflation, but slightly more competitive interest rate. Certainly going to be more competitive than a CD type rate. You're going to be taking a little bit more risk though. So what's this mean? Now that you're earning, and hopefully you will start earning a little bit more on your cash, all right, it's a little bit less painful to have that emergency fund. But I would still tell you, don't be distracted. Don't be distracted by high inflation and other things with your emergency fund. Yeah, if you're sitting on too much cash, you got to work with your CFP, see what the right strategy is to deploy that cash. But your emergency fund dollars, they're not out there trying to make you rich. They're designed to keep you from going poor. Now, the disappointing thing is having dollars sit in the bank for any time over the last 15 years has meant that those dollars are going poor, right? You're not keeping up with inflation. That's a flaw in the monetary policy that we've been executing in this country and really around the globe. And even though I can point that out, I don't have the solution either. So you're not going to get that from me. But that's the predicament we're in, okay? Those dollars are slightly losing their purchasing power every single day because they can't keep up with inflation. Still, they're designed to be there when you need them at a moment's notice in an emergency so that you can also go out and be very aggressive attacking your other financial goals with those dollars. And then finally, if you have debt at a variable interest rate, honestly, the arbitrage play here would have been to forecast and see this coming, which would have been impossible, and borrow as much money as possible at fixed interest rates, 2.5% mortgage for 30 years. That would have been ideal, okay? But those of you that didn't do that, and the rest of us that aren't clairvoyant and can't see the future, right? If you have variable debt and you're sitting on a lot of cash, there could be an arbitrage strategy as well, because even though those interest rates are going up on your cash, they're going up on the debt faster. And so work with your CFP to figure out a strategy to use those dollars that are in cash, maybe not earning as much, and paying down that debt that is going to start costing you more and more interest. Work with your certified financial planner. See how much you should have in an emergency fund. See if there's extra dollars there and what your strategy should be. If you do have an emergency fund, are you using the right savings account, that right high yield bank account? If you have long-term dollars, investment dollars that you want to keep in a safe and steady fixed investment, what's the right strategy for you? All of those questions are financial planning questions you should be working with your CFP on. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.